Hey, welcome everybody to the 40 Finance channel. Today I'm going to take a handful of my stocks and just share a projection of how far could they fall if we ever did see a broader market correction or a dip. Of course, I've been waiting for one for however many months now, but it's nice to have sort of like a price target in mind if you're going to add to some of your existing positions. So we'll jump through a few of my stocks and look at the charts and the data and try to make a projection if the market deflated and demand came down for some of these names, how far down would they actually go? All right, we'll kick things off with one of my most recent additions, and that is Zillow Group. I chose ticker symbol ZG for the Class A shares, but it also goes the same for the Class C shares with ticker symbol Z. And you can see this year-to-date chart, definitely the bubble deflating in Zillow, and I attribute a lot of this to the media companies out there that are just can't get enough of predicting some sort of real estate demise. Honestly, for me, if you read the other headlines that talk about the demand for housing and the shortage of housing that we have here in America, I tend to believe that there's still a lot of life left in the real estate market, but you're going to be fighting this negative headline news for a long time. So Zillow could see a lot of downside if there was a market correction. Today's P/E ratio of 154. Got just a little EPS here. It's not really Zillow's goal right now, but 60 cents. So let's take a look at where things are headed in the future real quick. We have a projection of $1.20 for the EPS this year and about flat for next year. So on the EPS side anyway, there's not really like a huge light at the end of the tunnel, but if we go down to the revenue side, you've got plus 96% this year, plus 48% next year. It gets a little goofy though with Zillow because of that home buyer program. So they could have wide-ranging revenue numbers depending on how many of the homes that they bought they actually sold. So their profit margin is going to be very hard to digest over the next couple years as they get this program going. So it's sort of like you either believe in it or you don't. And if things go wrong, we'll take a look at the technicals here. This one's already losing a lot of steam. If things go wrong for Zillow, they could really go wrong for the stock. So you see we're at $92 right now, which in comparison to recent history, when it hit a high of 200 back in February, you might be thinking, oh, well, this is certainly a buy low opportunity. On the other hand, I have been buying at this price, and I will continue to around this $90 range. But it really wouldn't surprise me to see Zillow drop into the 70s, believe it or not, if we had a broader market correction. I think that would be on the extreme side. But if you see Zillow for maybe $75 or so, I certainly would be picking it up at that price with the intention to hold it for a long time because it's going to take a while to balance this business out, right? They have a profitable arm with their advertising and their agent relationships. The home buying is a little bit of an X factor. We'll see how that comes to light, but I bet you it's going to be 3 to 5 years for Zillow before they start making, let's call it, predictable profits going forward. All right, next on my list is Amazon. Amazon's one that I started a position this year, about $3,200, I think, something like that, $3,100. And it's really been stuck in the mud, to be honest with you. They have spent a lot of capital on improving their operations, and I think they have a very bright future ahead of them. But investors haven't really gotten behind the story of Amazon and its next leg of their journey, if you will. When we take a look at the analysis column, though, I would say that Amazon's one of the safer bets out there. You've got a projected EPS of 53 some odd dollars this year. That jumps 14 some dollars next year. So that P ratio is really going to take a nosedive in a positive way heading into next year. And while sales growth isn't on the same par that we've seen Amazon over the past several years, you got plus 23%. I'm guessing this number at plus 18 really trends closer to plus 20. But the slowing growth is probably why investors, at least right now, are not super attracted to it. But I got to tell you, when you have $476 billion in revenue, it's not easy to grow that number, okay? So if you're growing that thing at 20%, you're doing a pretty good job. Looking at the year-to-date technicals chart, you can see that Amazon's relatively predictable, and you get this little dip under the 200-day, which we've also seen here. We've also seen here. Those are areas where the market was relatively weak. So if I had to guess where Amazon would land now on a market correction, I think it would be up a little bit from this 3180 number, maybe settling in about 32 or something like that. But on the same token, it kind of depends on which news pushes it, because if we see COVID news, for example, while that could be good for Amazon, the cost and expenses that they had to outlay to handle COVID, I could see it dragging this thing down to maybe $3,100, and I would certainly be a buyer at that point. All right, how about Palantir? This is one that I built up my position in and around $22, something like that. And it's one that, quite honestly, it's running ahead of itself. If you get down to the actual fundamentals of the stock and the amount of revenue and the amount of profits that they're making. So this would be a riskier play in the terms of a market correction. I could see a much bigger fallout from today's price of $28.43. You see that we're not profitable yet. And if we go and look at even just price to sales on this Yahoo chart, you're in the high 30s, which is definitely danger territory on a price to sales perspective. And when we look at this chart, anytime you have a high growth name, this is year to date, by the way, let's back this up a little. Let's go 3 months so that we have a closer look at the 200-day. I'll squeeze this in for a second. Sorry about that. And you can see this price action up to 28.41 right now, way above the 200-day moving average. When the market has its soft spots, most notably, let's go back here a little bit. Let's see what it did in May when things are really going a little soft in the market. You dropped down to 18, then you had another dip in July of about 21. So does it get back to 20 in a broader market correction? I could see that. I would be a buyer there, but it wouldn't surprise me too, because this is a high growth name with a lot of fluff to it. I could definitely see a $20 price show up if we got major weakness in the market, because a lot of people on stocks like these, they're going to freak out that the market's crashing and they're going to bail on it. That's another one I would certainly be buying at $20. All right, what about DraftKings? And DraftKings is very interesting because they're heading into their peak season. It's a very seasonal stock, summertime, a lot of low sports news. Now we're in football season, and you can see on this year to date how we've sort of popped back up. But how would a correction affect DraftKings during the football season when things are supposed to be going well? It is another one, though, where I would say, as much as I love my DraftKings stock, we are a little inflated here. Price to sales 21x, that is down. And if you watch my other videos, I do believe DraftKings has a very solid multi-tier revenue growth strategy across the board that I'm looking forward to watch develop over the next few years. But anything that's going to be running in the 20s, particularly on the competitive gambling side in price to sales, it's certainly going to be at risk for a correction of some kind. squeeze this chart in here a little bit. This is 6-month chart. Let's back out a little bit to try to get a feel for where football season was last year. Heading into the high point of the market, which of course was February, you were all the way up to 71.98. We're starting to get to that trend again when it's going up, up, up. So I expect some of these floors to escalate a little bit. I doubt you're going to see 43, but don't be surprised if we saw a broader market correction. If you get into this here $50 range, it looks like a really good spot for it to drop to, maybe into the high 40s. My cost basis on DraftKings is about $35. I don't know if I would buy at 50 necessarily, but it would certainly be something to consider. All right, how about Visa, which is one of my top holdings? And I've talked on the live stream the other day about the risk to Visa right now, not only in the travel world, but business travel. You also have the interest in cryptocurrency. So Visa has some threats out there. Their biggest threat, though, is the world not getting back to a normal pace anytime soon. And if you had a correction that was based on some sort of COVID stat or Delta variant or whatever it is, then I think you'll definitely see some weakness in Visa. Now, when we look at it from a historical standpoint, Visa's 30x on their forward PE is definitely running hotter than it has in normal times. It wouldn't surprise me to see this 30x multiple drop down closer to this 26 or 28. And on the chart side, we are right on the cusp of the 200-day. So the question is, how far would it go from here if there was general market weakness? To be honest with you, I would probably say that Visa could get as low as 215, maybe 210. But that would have to be the story where you're seeing Visa impacted by a lack of consumer activity for whatever reason. I think the floor is low with this one, but it would be the type of news that could impact it. It would also be considered one, oddly enough, because it's sort of a blue chip, if you will. It could be one that people come into in the face of a market meltdown, because it does offer some safety and stability, as well as positive upside over the next 2 years as things continue to rebuild. All right, next up is Square. Square is one that I would put firmly in the overvalued category. Price to sales today at 8 times, definitely in line with what we've seen in the past. And the forward PE is dropping a little bit, though you had several opportunities to get it back in 18 and 19, well under the 100. The problem with Square, as I've mentioned before, the EPS is growing. So if you did get to 237 in 2022, you know, that's gives you about 100 or so, I guess, on the PE range. But there is slowing revenue being projected right now for 2022, going from 100 times or 100% growth this year to maybe mid-teens next year. So that's going to weigh down on investors' decisions if this has a little bit of a meltdown. Now, on the chart side, we're trading pretty tight between 50 and 200. If we go back to the last couple instances of weakness, this would have been around May or so. You did dip below the 200-day. So if that 200-day is at 238 now, so maybe if you did dip under this 238, 200-day, you could get to 225 or something like that. The thing that has always helped out Square is sort of the momentum, right? People are just infatuated with this company and its prospects for the future with Cash App, etc. They would face a similar challenge to Visa in what type of news is dragging down the market for a correction, right? If it has anything to do with lockdowns and consumer behavior, we could see that come down even more, at least in the short term. All right, next up is PayPal. And while I do love my PayPal, and it's my number one holding, I have no plans to sell, I do think it has some room to drop, certainly in a correction. You're at 48 times forward PE right now. Historically, they've been in that 30 range, so there's a number of points that could drop off if there was a market correction. On the analysis side, you have the good news of a strong EPS growth. This is non-GAAP. Could get as high as 584 next year, so you do have some support. But if this is 584, call it 6 just to make the math simple. 6 times a 30x multiple is only $180. That could mean $100 at risk if traders start trading at that valuation. On the bright side, even with their $25 billion, you've got nice growth, plus 20%, even more growth next year at plus 23%. So there's definitely some good points in here. If we go to the year-to-date chart, we are below the 50-day, which is a positive, well above 200-day. And if I went back to May and we look at what the weakness brought then, you're a couple steps under the 50-day at 239 at that point. We saw similar type activity here, 268 or so. Frankly, it wouldn't surprise me if we got much closer to 262, perhaps even, dare I say, 250 for PayPal, only because it's been on such a hot streak. I have no qualms about PayPal's future and which direction they're going. If it did get to 250, I'd have to consider adding to my shares, though it is my number one position, and I'm at like $190 or something on it. So more than likely, I would probably look for better deals in respect to other places in my portfolio that I need to add to. All right, last one on the board is Etsy. And you see on Etsy's year-to-date chart, you had the May low, and it's come up, even though a lot of people were talking about the end of e-commerce, the end of shop at home. But from a valuation perspective right now, this one is still trading under the premium that folks were paying in 2020, and it's still in line with, if not lower than, some of the premium we saw in 19, 18, and 17. And this comes on the heels of projected growth. We still have a little bit of EPS growth coming in. Looks like they'll add about 60 cents or so this year. Oh, actually, that's like more like 33 cents. Then next year they could add 60 cents, and you're still rocking plus 20% growth rate next year. And if the past is any indication of the future, Etsy's done a pretty good job of outperforming expectations on both the top and bottom line. All right, year-to-date technicals, we are in line, it looks like right now, with the prices that we were seeing in April, not quite as high as February, but right in this April range. When we had the May correction, Etsy sort of stayed where it was for a long time. We were in summertime, and everybody thought the same thing, which is folks are going to go out and enjoy life, and they're not going to use online commerce or the type of craft-ish goods that Etsy sells. And yet they've had nothing but good news over the summer. They even made a couple small acquisitions. In the past 6 weeks or so, it's been a very good trend line towards the positive. But where would it go in a dip? For me, I would say that it wouldn't be unheard of to catch something under this 200-day moving average. Last time that was 178 back in August. I'll go ahead and say 185 maybe, 190, something like that if we had a big correction. And at that case, I would probably add a few shares to my Etsy position. Right now, my cost basis is about $140. So depending on what else drops and how much it's being offered for, Etsy could be a good target. I think they have a long growth runway ahead of them. All right, guys, so that's an opinion on a few of the stocks that I own and sort of what kind of price range am I looking at to potentially add to my existing holdings in these cases. If you guys like this video, I'll try to pick off several other popular stocks, maybe ones that I don't own or they're on my watch list, and do the same kind of like opinion analysis on it. Just let me know in the comments. Thanks as always for watching. Please give a like, subscribe to the channel. We'll see you on the next video.